All right. Good morning, everybody. Looks like we've got a big chunk of you in here and ready to go. So let me go ahead and get started. Welcome to the Hurley Investments Trade Findings and Adjustments of January 13th, 2022. Boy, that's always weird to say. All right. So I was with you. My name's Keith Bybee. A couple of new folks coming in just to introduce myself. I'm Kevin Hurley's partner at Hurley Investments. I typically do these trade findings and adjustments for the most part. Sometimes we trade off and take over one or the other. All right, so my last trade findings was December 16th, so pretty close to a month here. We take a little break over that holiday couple of weeks. Last time I went over a little bit about the stock market, and you can throw that in with economics, and markets in general. A lot of time spent on people trying to predict the future, and it's really not how it works. Economics is not a real science. It's more of extrapolation. We look at past things in the form of technical charts and compare price charts. I gave an example, gold versus the dollar, those kinds of things to see how different industries, how different commodities, how different stock industries, sectors, how they correlate or contrast. We look at all of this past information and make extrapolations as to what is the probabilities of the future. So this point, and I'll put that. This is one that we come back to throughout the year, and one that is important to understand and remember. And we're really just looking at probabilities. Went over fundamentals and technicals. Fundamentals trump technicals. Technicals give us an idea of market's perception and where big money, institutional money, might be stacking up buy and sell orders. And really our fundamentals give us a chance to decide if a company has a good probability of future growth and delivering value to shareholders. Kevin, as you probably saw, went over much of that and what we look in fundamentals and valuing companies. The last couple of webinars, he went over January 6th and the following trade findings last Thursday. Just looking at a couple of things. You can go back to those if you missed them. I strongly encourage that. Gives you a good idea of what we look at and why, and how we're looking to invest in different stocks. So if you wanted to see this information I went over, go back to myhurleyinvestment.com and go to the December 16th. So, gonna move all of this off. What I'd like to do for these first few webinars, trade findings and adjustments of the year, is go over a little bit of the basics and kind of get back to basic understanding of options and strategies we might use here and there. Typically, we'll have a trade every once in a while that we'll suggest if you're looking to put a slush fund of some kind and some extra cash to work to try and make a little bit extra on the side. So to get started, I'm going to go over 4 option instruments for the next 4 of my little webinars on Thursday mornings. And today, I'm going to put this in the center. Today, I'm going to go over the call, long call. One, all right. Okay. I still struggle with Microsoft Word, so please forgive me. Long call option. To buy a long call, we buy to open. So what does that mean? Long call just means a call option that you're buying to open, as opposed to what we'll go over next time, which is short call, which you're selling to open. So what's the difference? Buying to open means you are buying the option contract in order to buy rights and the rights associated with that contract. So what are the rights? Gives you, long call gives you the right to buy the underlying stock. It gives you the option and right to buy the underlying stock. Why they're called options? Because we have the option to do something, if we so choose. I'll put that it's a contract. It's important. So, gives you the rights, a contract that gives you the right to buy an underlying stock. And that contract goes up in value or down in value based on the movement of the stock. So you can say it moves with as a call option. Since you're buying a contract that gives you the right to buy the underlying stock, the price of that contract will move up and down with the stock. So I'll say with. Questions so far? I know many of you are fairly familiar with this, so I apologize if you're just getting a refresher course. But again, want to make sure we're getting back to basics, especially for you new folks. Okay, so long call, again, gives you the right to buy. It's a debit. As opposed to a credit. When we're selling a call option, and we'll get to that one next time, you're getting credit. You're selling to open to get credit of that premium. But today we're talking about buying or debit, placing a debit trade where we pay a premium for the contract. So, example, Apple trading at somewhere around 175 right now. Might have options, call options, that cost $5, $7, however many dollars. Just giving you, there's a range of bunch of different prices because there's different contracts at different places and that last certain times. So just an example, there's a difference between the premium we pay for the option and the price of the stock. I'll say might. All right, so what's next? Each option, I'll say many different option choices. Before I do that, let me add to this one. We have the right to buy the underlying stock for a certain time period. We have the right to buy the underlying stock at a certain stock price for a certain period of time. And you pay some sort of premium for that right in that contract. So we have what's called strike price and expiration. And you choose one option that will have both of those. So you can have Apple again. Remember, it's trading at around 175. So there will be a 175 option contract that you pay that premium for. And it will last a certain amount of time. So you call that a 175 strike. And then it'll have a date on it. And we'll go over how it looks and everything in just a second. We'll do February 18, 2022. This is what it will look like. And it will also have, you will have what's called an option chain that shows all sorts of different strike prices, and you look at different dates at a time. Selecting your date and you get a whole chain of different strike prices. And they can be in increments of 5 or $1 or 50 cents. It just depends on the stock and kind of what price it is. And also sometimes the date affects what increments it might have available. So this is kind of where it gets a little confusing, but any questions so far? So this one, yes, Dave, I was just going to say that. This one would be the right to buy Apple at 175. That's the strike price. And you have that right for all the way out to February 18th, 2022, about a month out, a little over, right? So what happens? And let me add some, it will be some random, not random, but will be a price like that. Excuse me. So 522, $5.22, we'll say. So what does that mean? Well, options control 100 shares of underlying stock. That means you get the right to buy for one contract, and I'll say that one option contract controls 100 shares. That means if you exercise or I guess call in, it's the term is referred to as exercise, when you're basically saying, hey, I'm going to do this, I'm going to exercise my right to buy. You would get 100 shares at 175 plus the cost of the premium. So even though it's listed at 522, you got to multiply that by 100 because it's 100 shares of underlying stock. So this option would be $522. Even though it's listed as 522. So let's take a look real quick. Let's look at an option chain. So here's an option chain. You'll notice in the middle we have our date and how many days left to expiration. This one is a long one. We go out a long time. And this side we have our calls. Here's our date again. Here's our calls. Here's our puts. We'll go over puts obviously another time. Different rights, different things associated with that one. This one we typically call long-term, like out a year, 6 months or more. We call these leap call, long call options. And you can see all these dates up here. These are our expiration dates that we can choose from. You see this check mark gives me this January 23. And I can select a bunch of different ones based on different dates. So I'm going to erase those. So then we have our strike prices. You'll notice, and this is Facebook up here, Meta Platforms, since they changed their name. These are our strike prices. These are the different share prices that we can have the right to buy shares of stock. And you'll notice these different colors. It will be a little different on different platforms, but generally there's going to be a shaded color above one and a shaded color above the other. This is just showing where the closest options are to the current stock price. So you see over here, 328. This kind of gives you the open, high, and low of the day, but this is the current price, 328. So that fits between our 330, 325 is going to be at the money, what we call at the money. And for call options, everything below, you see these prices going up are lower than the stock price, so below the stock price. Those are out of the money. In the money, right here, out of the money calls. Oh my gosh, I totally screwed that up. Let me say that again. These would be in the money, forgive me, because they're all lower. Stock price keeps going up. These ones will continue to go in the money, and because these are above the stock price, these are out of the money calls. So again, below the call, below the share price calls are in the money, above the share price calls, out of the money. At the share price calls, at the money. All right, so kind of a lot for one day. We can ask questions if we need to, have some time for that. Looks like everybody is sticking with me. A couple of you here, more that you showed up. Good to have you guys as well. All right, so that's our option chain. Everybody, again, below our stock price is in the money on calls. All of these prices, strike prices above are out of the money. So I like leap long calls. Let me go over leap long calls. This is kind of our strategy that we stick to most often with trading options. We have all of this time, just a little under a year, where we can have the right to buy stock. Rarely, if ever, I've actually never exercised a call option to buy shares of stock, but we like to think of it as somewhat of a stock replacement strategy. So if we looked at, we'll say 350s, that gets you a little out of the money, kind of further up. Let me look at a Facebook chart. So 350, kind of in the middle between recent highs and certainly could get up much further on highs way back here in September. If you were at Kevin's fundamentals webinar the last couple times, you can go back if you haven't and watch those. But he kind of goes over a little bit of Facebook, and you can see from that some of the value and potential growth for Facebook. So these premiums, you'll notice, are quite a bit higher than the other example with Apple for $5 that I gave you. When you're going further out for more time, you pay more premium for that extra time. So rather than a month, going out a year. So again, multiply this by 100, we're looking at $3,700 to buy this all the way out for a year. So it's not as though it's the cheapest thing in the world, but if we're really trying to just follow the stock, you need plenty of time in case it goes the wrong way. So, talked a little bit about calls in general. Let's talk about leap call stock replacement strategy. go out to an expiration 1 year or more. And the way you decide how many contracts you buy, here you have your quantity, different brokerages and whatnot will have different ways that this order ticket looks, but obviously everything is called the same. So we have our call, buy, you can sell, that's the other side of it. That gives you obligations and unlimited risk. So please do not do that. We'll go over short call next time and a strategy we might use for a short call that isn't ridiculously risky. All right, so we've got our date of expiration, our strike price at 350. So how do we decide how much to buy? So the rule of thumb here is if this contract loses half its value, and they do this all the time, even if the stock price hasn't. Stock price may only go down a little bit, you know, even 10, 15, $20 for something like a $300 Facebook stock could cause this to lose a lot of value because it's based on the right to buy. So if there's less likely a chance that this stock will go up above 350, then it's going to be much cheaper. As it comes up, that means it's more likely that the stock will close or go above that strike price, and the more valuable this contract becomes. So because it moves up and down with the stock price, we think of it a bit of as a stock replacement. So do your math. $350 per share times 100. If you went out and bought the shares of stock, you're looking at $35,000 at 100 shares versus we just talked about just under $3,700. So about 10% of what you'd actually be paying in overall cost. So you have 10% of the risk of the stock. So right there we have some inherent hedging because we're risking far less than we would in total dollar amount. So the way we set this up, if you have a contract like this, costs about $3,700. What you want to do is leave room and cash in your account to be able to buy this contract a couple more times, 2-3 times, and double down if needed, if this goes the wrong way. So if this gets cut in half, what, $16, $17, somewhere around there, we're going to look at our chart, see if there's a place that it's at where Facebook feels like there's some support level that they can bounce off of. We might look at that and think, all right, so there's a place of technical support where it could continue to move up or bounce off of, and it's about half off. We're going to buy another one of these in dollar cost average. So your idea is to keep enough cash in your account where you can dollar cost average these and double down at least 3 times. So do your math on that. Obviously, if you're doubling down, it's half off. the price is going to be a little cheaper. So just keep those numbers in mind. So $3,700. Here's our example. Facebook 350 strike out to January 23, right? Why did we go up to 350 strike? Well, going back to the chart I showed you, it can get up to 350. It's a little cheaper than going right at the money, right? When it gets about right at the money, it will be worth about 45 some odd dollars that it is right at the money on a 330 if it gets up there to 350. But I'm simply just looking at a chart. Where's a little bit out of the money where we can save, not have to pay $45 for the premium. Where has it gotten up to before? You'd seen what Kevin had done for analysis. It can get up to $400 a share or higher on his valuation. So there's plenty of upside. We're just going a little bit above the stock current price to save a little bit of money. And again, just looking at nearest highs, nearest all-time highs, which was up here at 382, I believe. And just making some judgments based on that. Make the note higher strike are cheaper. Everybody following along, not getting questions, which I'm not sure if is a good thing or bad thing. So let's say I've got about $10,000 slush fund. I would probably be starting out with no more than one. And if I was planning on putting on a couple other positions, probably only be looking at one or two, and they would probably need to be cheaper one. Different cheaper stocks will have a cheaper premium on these options. Just kind of keeping everything in mind with down the road. If Facebook just has another antitrust news article come out, some article about how they're destroying teenagers again, and this continues to fall, you just want to give yourself enough room where you can dollar cost average, put more money to work, and lower the cost basis, lower the cost you need Facebook to come back up to meet your break even. So it's the same principle when we talk about protecting our stock ownership, so that if our stock falls, we can cash that protection in and that insurance in for more shares of stock and lower the cost basis, lower our break-even cost so that we're profitable at a lower stock price than we originally purchased. And we keep it simple in this strategy by waiting until it's half off. Wait until our option contract is half off of the original price before considering doubling down. Let's see. I don't want to say another contract because sometimes, obviously, we might, depending on the cost and how much cash we have, we might want to buy 2 contracts or start with 4 contracts. But again, the thinking is, how much cash do we need to hold on the sidelines so that we can double down, buy more contracts when the price is half off. All right. So here's our example. Let me take a picture of this. Actually, trash this. Let me get in the middle. Our prices come down. Bid and ask. This is our spread. You want to go in the middle to get the even price where you would get filled at, or if you want to go a little cheaper and wait to see if the stock loses a little bit of value before you get filled, kind of up to you. Or you can do a market order and just get filled at wherever that closest place is trading, which is usually around the mid. Let's see. All right. So 350 call all the way out a year. Smaller account, you'd buy 1 on the idea that if it goes down to 16, 17, you'd look at buying another 1, and also leaving room where if it goes half off again, you'd have enough room to buy another 1. We want to avoid, let me put this up here. doubling down more than 3 times. Reason being is you can get caught dollar cost averaging and dollar cost averaging, hoping a stock will come back and continue to throw good money at bad. So at some point, you kind of got to leave yourself a limit. We had run call options on Boeing beginning of 2020. Those obviously fell down significantly. That stock went down 75%, I think. And because it had gone down so quick, we waited, didn't dollar cost average really yet when we were half off our price, original price. Waited till it found a bottom to bounce on, and then dollar cost averaged, and it had gone up and gone down more. We dollar cost averaged again, but we really stuck to about 3 times. I believe we might have done a 4th one, just off of memory, but I'm pretty sure we stuck to around 3 times. And as Boeing came back up from, just under 100, all the way back up to 180-ish by the end of the year, we were not only hitting our break even, we were much farther ahead of it. In fact, they might have been up at 200. Yes, beginning of 2021, Boeing was up around 200, and we were significantly profitable as it came back up. So holding to that 3-time rule is a good idea. All right, so here we got this one, $36 or $3,600 in total. You can kind of see that. You go next, preview. Oh, well, we get order errors because everybody is out of E-Trade and over to Schwab, but what you would see is they would give you a ticket. Are you sure you want to do this? And it shows you the exact dollar amount you're paying to buy this contract, and you now have the right to buy shares. Again, we're not really looking at doing that. We're looking at following the trend of a stock as a sort of stock replacement strategy, so that we can have 90% or more less risk on the table than having to buy all those shares of stock. Guys, is there any thoughts, questions, anything I missed? Kind of new for me to go back to really the very fundamental basics. I know many of you understand and already know how this works, but just wanted to give those of you who are new a better idea of what this all looks like and what it all means. Again, we'll go over puts another time. You know, puts as our insurance. That gives us the right to sell stock, excuse me. Puts give us the right to sell at a certain price, therefore kind of acting more of an insurance. If it falls, we can sell high after the fact. Okay. Last detail, let's say this goes up in price, we're happy with it, up at Facebook trading it back at 380. We've decided we've made a nice chunk of change. We can close that. Never a bad idea to take a profit. Typically, we're waiting for 100% return if we have a good, strong belief that there's more upside in a certain stock, which certainly there should be for something like Facebook. 100% return on a call is a call contract sounds like a lot, but these things move big and they're volatile, which is why we're not throwing everything on black on the roulette table. Leaving the cash, your safety is your cash to lower your cost basis, dollar cost average. And this has been the most simple yet effective, best way that I personally have traded in a small slush fund account. I sold a car back, what, 2015, 2014 for like $6,000 and traded with cash and leap long calls and various different stocks, and that account is now trading at a value of $26,000. So it does work. All right, guys. Last chance for questions. And if not, hope this was educational. Come back next time with more questions if you need to on this. And otherwise, take care. Have a good rest of your week and your weekend, long weekend. Markets closed Monday for MLK Day. All right, guys, take care. Have a good one. See you next time.